Stop what you are doing for a moment and focus with me, because what just happened in the metals market is not small, and it is not normal, and it is not something you should ignore. Gold has fallen below 5,100, and silver is not just slipping lower, it is dropping fast in a way that feels like the floor disappeared under it. This is not a simple dip that traders brush off and call healthy, and it is not the kind of pullback that resets the market before another move up. Silver just crashed from $96 to under $80 in a matter of hours, and moves like that do not happen in calm markets. When you see that kind of speed and that kind of damage in such a short time, you are not watching normal selling, you are watching stress inside the system. And I need to tell you something clearly right at the start. This kind of drop usually does not end in one day, and the pressure we are seeing right now may only be the beginning. Today on Alex Carter Reports, I am going to walk you through what is really going on beneath the surface, because the headlines are not explaining it properly. I am going to show you why this crash is happening now, who benefits from it, and why history says this kind of event follows a pattern that most people miss. But before we go deeper, I need to be honest with you, because trust matters more than being right all the time. In my previous breakdown, I said that $85 to $86 looked like strong support for silver, and I believed that level would hold. I explained that it could act like the new $70 floor, meaning price might dip toward it but should find buyers there. That level did not hold. Silver did not bounce strongly from 85. It sliced through it like there was nothing there, and that changes the short-term picture in a serious way. When support levels break that easily, it tells you that buyers are not in control anymore, at least not for now. But here is what I also said weeks ago inside the deeper analysis on Alex Carter Reports, and this part played out exactly as expected. I gave the zone between $95 and $102 as the area where silver would likely form its next lower high. Silver topped out at 96 before turning down hard, which means the structure I warned about showed up almost perfectly. The top call was accurate, but the strength of the breakdown under 85 is what changed the tone of this market. Now let's talk about gold, because gold set the stage for what silver is doing. Gold opened strong and pushed toward 5,400, which I had already marked as a key resistance level. I said clearly that if gold could break cleanly above 5,400 and hold, we could see new highs quickly, but if it failed at 5,400, the rejection could be aggressive and painful. Gold touched 5,418 and then started falling, and at first it looked like a normal rejection. In a healthy market, price might pull back to around 5,250 or 5,200, slow down and stabilize. That is not what happened. Instead of finding a floor near the breakout zone, gold kept sliding lower and lower without real support. It dropped under 5,200, then under 5,100. And as I am explaining this, it is still struggling to find steady ground. That kind of move is not just rejection, it is a breakdown. When resistance pushes price down and there are no strong buyers waiting nearby, it tells you selling pressure is overwhelming demand. The traders who bought the breakout move likely used leverage, and when price turned against them, their risk limits were triggered. Stop losses were hit, margin calls were made, and positions were forced closed. That kind of forced selling feeds on itself, because every sale pushes the price lower and creates more stress for the next group of traders. Now here is something important that many people do not fully understand, and it explains why silver is falling even faster than gold. Silver moves like a high-octane version of gold, meaning when gold drops a little, silver usually drops more. If gold falls 5%, silver might fall 15%, and when gold falls 10%, silver can lose 25 or even 30%. That is because silver attracts more speculative money, and speculative money often uses leverage. Leverage makes gains look exciting on the way up, but it makes losses brutal on the way down. Right now, that leverage is working in the worst possible direction. Gold has fallen several $100s from its recent high, and silver has been cut almost in half from its peak levels. That is not because silver suddenly became useless, it is because leveraged positions are being crushed. And here is where things get deeper than just charts and price levels. Today, $9 billion was pulled from the Federal Reserve's repo facility in emergency borrowing. Most people hear the words repo market and tune out, but this is critical to understanding what is happening. The repo market is where banks go to borrow short-term cash, usually overnight, when they need quick liquidity. After the 2008 crisis, the Federal Reserve created a system so banks could access emergency funds if something went wrong. For weeks, that facility was barely being used, which suggested there was no major stress in the system. Then suddenly, on March 2nd, $9 billion was tapped in one day. That included $3 billion in treasuries and $6 billion in mortgage-backed securities. When banks rush to that window for billions in cash, it usually means something inside the system is under pressure. At the same time, bond yields have been rising, and the next expected rate cut has been pushed further out. Bonds are not acting like a safe place to hide. Gold is falling instead of rising. Silver is collapsing even harder. Bitcoin is under pressure too. When everything drops together, that often points to one thing: a liquidity squeeze. In a liquidity squeeze, cash becomes the only thing that matters. Funds sell what they can, not what they want, just to raise money quickly. This kind of selling is not emotional, it is mechanical. If a trader or fund cannot meet margin requirements, positions are liquidated automatically. The broker does not care about the long-term story or the geopolitical risks. They just sell at market price to protect themselves. That forced selling creates a waterfall effect, where one margin call triggers another. Every drop in price puts new accounts under stress. More selling follows, more stops are triggered, and the cycle feeds itself. This is very different from normal investors deciding gold is no longer attractive. Voluntary selling usually slows down when price reaches levels buyers see as fair value. Forced liquidation does not stop because of value. It stops only when the margin pressure finally eases, and right now there is no clear sign that pressure has fully eased. Here on Alex Carter Reports, my goal is not to create panic, but to explain the mechanics so you do not make decisions based only on fear. The fundamentals in the world have not suddenly improved overnight. The Strait of Hormuz still has major traffic disruptions, and that affects a large part of global oil supply. Political tensions are not cooling down, and leaders are not signaling peace just yet. Yet despite all that, gold and silver are falling hard. That tells you the short-term driver is not fundamentals, it is positioning. Positioning can change fast, especially when leverage is involved. Fundamentals move slowly, but leverage can unwind in hours. Right now we are watching leverage unwind in real time. And when leverage unwinds, price can disconnect from reality for a while. Understanding that difference is the key to surviving markets like this. This is not the first time precious metals have crashed during a crisis. History shows that during liquidity squeezes, even safe assets get sold. But history also shows that forced liquidation does not last forever. The real question is not whether volatility will continue, but how long the forced selling phase will run. For now, understand this clearly. The speed of this drop is about leverage and liquidity, not about gold or silver suddenly losing their long-term purpose. Stay with me, because what comes next will connect the historical pattern to what we are living through right now. Now let's step back and look at something bigger. Because if you only focus on today's red candles, you will miss the larger pattern that is repeated again and again throughout financial history. What we are seeing right now is not new, even though it feels intense and chaotic in the moment. Every major crash in precious metals during a global crisis has followed almost the same emotional script, and that script always confuses people at first. There is a shock event that pushes fear into the system, money rushes into gold and silver, prices spike fast, and leverage builds quietly in the background. Then something snaps. It might be rising rates, a funding squeeze, a margin hike, or stress in the banking system, but once that trigger hits, leverage positions begin to unwind. And when they unwind violently. Let's go back to 2008 for a moment, because that year teaches one of the clearest lessons about forced liquidation. When the financial system was cracking and major institutions were failing, many people expected gold to skyrocket immediately. Instead, gold dropped more than 30% in a matter of months. Silver was hit even harder, falling nearly in half during the worst of the panic. That drop confused almost everyone watching from the outside. How could gold fall when the banking system itself looked unstable? The answer was not that gold failed as protection, but that hedge funds and large institutions were being crushed by margin calls. They had to raise cash fast, and when you need cash fast, you sell whatever you can sell. Gold and silver are liquid markets, so they became easy targets for forced selling. That selling pressure pushed prices down sharply, even though the fundamental reasons to own gold were getting stronger by the day. Once the margin calls slowed down and the forced liquidation phase ended, gold reversed hard. It went from under $700 to over $1,900 within a few years. Silver went from under $9 to nearly $50 during that cycle. The crash phase lasted months. The recovery phase lasted years. The people who sold at the bottom believed gold had failed. The people who understood the liquidity cycle realized the story was far from over. Fast forward to 2011, and silver once again teaches the same lesson. Silver had surged to $49, and excitement was everywhere. Retail investors piled in near the top because the move felt unstoppable. Then margin requirements were raised, leverage became too heavy, and the market snapped. Silver crashed from $49 to $26 in just weeks. Half the value gone in a short window of time. Once again, many believed the metal was finished. Once again, the crash was driven by leverage being unwound. Once again, the story did not end there. The pattern repeated in 2020 when the global shutdown began. In March of that year, nearly every asset dropped at the same time. Stocks fell, gold fell, silver fell. Even bonds were unstable for a brief moment. It was not about fundamentals. it was about cash. Funds and investors needed liquidity all at once, and the only way to get it quickly was to sell what they owned. Gold dropped from around $1,700 to near $1,470 during that panic. Silver dropped even more sharply on a percentage basis. But within months, gold surged to new highs near $2,000. The same pattern showed up again. Forced liquidation first, strong recovery later. That is why what we are seeing now should be studied calmly, not emotionally. When everything drops together, it is usually a liquidity problem, not a belief problem. Investors are not suddenly deciding that gold and silver are useless. They are being forced to raise cash to cover losses somewhere else. That is an important difference. Now let's connect this to the current situation more directly. At the same time gold and silver are crashing, we are seeing stress signals from the financial plumbing of the system. The $9 billion draw from the Federal Reserve's repo facility is not a random detail. It suggests that at least one major institution needed quick cash support. When you combine that with rising bond yields and delayed expectations for rate cuts, you see a picture of tightening liquidity. Liquidity is like oxygen for leveraged markets. When oxygen is flowing freely, traders can take bigger risks and survive small pullbacks. When oxygen gets restricted, even small moves can become deadly. Right now, the oxygen supply looks strained. That strain makes every leveraged position more fragile. And when fragile positions begin to break, they create pressure that spreads outward. It does not stay contained in one asset. That is why we are seeing gold, silver, and other markets under stress at the same time. This is not the market calmly pricing in peace or stability. It is the market reacting to forced deleveraging. There is another important factor to consider. Physical demand and paper price are not always moving together. On futures exchanges, contracts can be sold quickly and in large size. But physical metal does not move that fast. When panic hits paper markets, the price can fall sharply even if physical buyers remain steady. That disconnect can create confusion. It can make it seem like the entire thesis for owning metals has collapsed. But in many past cases, the disconnect was temporary. Paper contracts were sold aggressively. Physical metal was quietly accumulated by stronger hands. The visible price fell. The long-term demand picture did not disappear. Now let's talk about psychology, because psychology drives the most painful part of these cycles. During a crash, fear spreads faster than facts. Investors see red screens and assume something fundamental must have changed. They begin to doubt their earlier decisions. They replay every buy in their head. They wonder if they were wrong all along. That emotional spiral is part of the process. Markets shake out weak hands before a new cycle can begin. That shaking does not mean the asset is worthless. It means the structure is resetting. If you look at the chart structure right now, you will notice something important. Lower highs and lower lows are forming in the short term. That is what downtrends look like. They rarely move straight down without pauses. Instead, they bounce, give hope, then roll over again. Those bounces can be convincing. They can make it seem like the worst is over. But until the pattern of lower highs stops, caution is necessary. In past crashes, the real bottom formed only after price stabilized for several days, and selling pressure clearly slowed. Volume began to shrink, candles became smaller, volatility eased, and liquidity stress signals started calming down. We are not fully there yet. That does not mean a rebound is impossible. It means the forced selling phase may not be finished. One of the hardest truths about markets is that timing is unpredictable. History shows recovery happens, but it does not always happen immediately. Sometimes the market needs time to exhaust the sellers. Sometimes it needs one final wave of panic. The key lesson from past cycles is not to assume that price equals truth in the middle of a liquidity event. Price during panic reflects pressure, not value. Value tends to reassert itself later. Here on Alex Carter Reports, the goal is not to promise quick gains or easy answers. It is to explain how these cycles unfold so you can think clearly while others react emotionally. Right now we are in the volatility phase. This is the uncomfortable middle part where forced selling and fear overlap. It feels dramatic, it feels unstable, it feels personal to anyone holding positions. But if history is a guide, this phase eventually transitions into stabilization. And stabilization eventually opens the door to repricing based on fundamentals again. The biggest mistake investors make during this phase is confusing temporary liquidation with permanent failure. The second biggest mistake is using too much leverage in an environment that punishes leverage. Leverage is powerful in calm markets. It is destructive in chaotic ones. That lesson has repeated in every metals crash of the last 20 years. As we move forward, watch for signs of stress easing rather than focusing only on price ticks. Watch liquidity indicators. Watch whether forced selling slows down. Watch whether price can hold a level for several sessions without breaking lower. Those are the clues that matter most. Because when the liquidation storm passes, markets often look very different than they did during the panic. Now we need to talk about what really matters from this point forward. because surviving a crash is not about guessing the exact bottom. It is about understanding what signals tell you the storm is slowing down. Right now, emotions are high, opinions are loud, and social media is full of extreme predictions on both sides. Some people are calling for total collapse, while others are already shouting that the bottom is in. The truth is usually found in the structure, not in the noise. When a forced liquidation event is nearing its end, the first sign is not a huge green candle. It is stability. Real stability does not mean price jumps for 2 hours and everyone celebrates. It means price finds a level and holds it for multiple full trading sessions without breaking lower. In past crashes, metals would test a level again and again, but buyers would consistently defend it. That repeated defense slowly rebuilds confidence in the market. Right now, we have not clearly seen that kind of strong base form yet. We are still in sharp swings, fast drops, and sudden bounces. That is what active liquidation looks like. The second signal to watch is the size of the selling waves. During the worst phase of a crash, each drop is large and violent. The candles are wide, volume is heavy, every rally gets crushed quickly. But when the selling pressure begins to fade, the candles start getting smaller. The drops are less dramatic. The rallies last a little longer. That shift does not feel exciting at first, but it is powerful. It shows that forced sellers are running out of inventory to dump. Another important sign is what happens inside the financial plumbing. Earlier we talked about the $9 billion draw from the Federal Reserve repo facility. If more large emergency liquidity pulls continue day after day, that tells you stress is still active. But if those numbers calm down and repo usage flattens again, that signals funding pressure is easing. When funding pressure eases, margin calls slow down. When margin calls slow down, forced selling loses momentum. That is how the cycle resets. There is also a global angle that cannot be ignored. Right now, geopolitical tension is not fading. The Strait of Hormuz is still facing disruption, and that affects a major portion of global oil flow. Political leaders are not speaking the language of de-escalation. In fact, statements have suggested further action could come. Historically, when geopolitical risk increases while metals are temporarily weak, the disconnect rarely lasts forever. Price and reality eventually meet again. Sometimes price drops first, then catches up higher later. Sometimes price spikes first, then corrects before continuing. But long-term trends usually follow the bigger forces in the world, not the short-term funding squeezes. This is where discipline becomes critical. If someone was using heavy leverage, this environment is unforgiving. Leverage multiplies profits, but it also multiplies stress. In volatile conditions with wars, shifting rate expectations and liquidity draws, leverage becomes the most dangerous tool in the room. That lesson has been repeated in 2008, 2011, 2020, and now again. On the other hand, if someone holds physical metal without leverage, the situation looks very different mechanically. The number on the screen may have dropped, but the physical metal in their possession has not changed weight, purity, or long-term demand. The crash is happening primarily in the paper contract world, where futures positions are forced to close quickly. Understanding the difference between paper price swings and physical supply trends is essential. During past liquidation phases, physical demand often stayed firm even while futures prices dropped sharply. Stronger hands accumulated quietly while panic dominated headlines. The transfer of metal often happened from weak holders to stronger ones. That is how wealth shifts in markets. It rarely moves in a straight line. It moves through emotional cycles. Fear at the bottom, excitement at the top, calm analysis somewhere in between. Right now we are closer to fear than excitement. That does not automatically mean the bottom is here. It means emotions are stretched. When emotions stretch too far in one direction, markets eventually rebalance. Another signal to monitor is correlation. During a liquidity crisis, almost everything falls together. Stocks, metals, crypto, sometimes even bonds. That everything down at once phase usually signals forced cash raising. But when correlations begin to break apart again, and assets start trading based on their own fundamentals, that often marks the shift from panic to normal behavior. Watch for that decoupling. It can happen quietly before headlines notice. Also pay attention to how rallies behave. In a healthy recovery, rallies are strong and they break previous lower highs. In an ongoing downtrend, rallies stall below prior peaks and then roll over. If gold and silver begin to break above recent lower highs and hold those gains, that would signal structural improvement. Until that happens, caution remains wise. This is not about predicting doom or promising a quick rebound. It is about recognizing the phase we are in. Phases change, but they rarely change overnight. They transition step by step. Now let's talk about mindset, because mindset determines survival. In crashes, people tend to focus only on what they lost. They forget to analyze why the move happened. They forget to separate mechanical selling from fundamental shifts. When you understand that margin calls create artificial pressure, you stop assuming that every red candle equals permanent damage. That clarity gives you patience. Patience is powerful in volatile markets. It keeps you from making rushed decisions based on fear. It keeps you from chasing every bounce out of desperation. Markets reward discipline over emotion. Right now, discipline means observing the signals, not reacting to every tick. It means asking whether liquidity stress is rising or falling. It means watching whether support levels begin to hold consistently. It means respecting volatility without being controlled by it. Here on Alex Carter Reports, the focus has always been on structure and data, not hype. We called the $95 to $102 silver zone before the reversal. We highlighted 5,400 as major resistance in gold. We identified 85 as a key level, and when it broke violently, we adjusted the outlook. That is how markets should be approached, with flexibility and honesty. No one controls the market. No one predicts every move perfectly, but you can understand the mechanics behind those moves. And when you understand the mechanics, you stay calmer than the crowd. As we move forward, expect volatility to remain elevated. March was already shaping up to be unstable, and it has delivered exactly that. There will likely be more sharp bounces. There may be more sudden drops. Both are normal in a liquidation cycle. The key question is whether the forced selling exhausts itself soon or continues longer. The answer will show up in the signals we discussed, not in emotional commentary. If stability forms, liquidity stress cools, and structure improves, the next chapter could look very different from today's chaos. If stress increases and funding pressure expands, then volatility could stretch further. Either way, knowledge is your advantage. The biggest disconnect right now is between price action and global tension. History shows that kind of gap rarely stays open forever. Price eventually adjusts to match reality. The only uncertainty is timing. So stay sharp, stay educated. Watch the signals, not the noise. If this breakdown helped you understand what is happening beneath the surface, make sure you are subscribed to Alex Carter Reports so you do not miss the next update. Share this with someone who is confused by the crash and needs a clear explanation of the mechanics behind it. Drop your thoughts in the comments and tell me where you think gold and silver stabilize. This was the full breakdown of the current crash cycle and how it connects to historical patterns.